Hey there, and welcome to the channel. Today I want to talk about this video, which is called The Art of Investing by Franc ois Rochon, where he did a Google Talk back in 2017, where he was sharing his investment approach. It's, in my opinion, one of the best videos about investing that you can find on YouTube. So what I want to do today is I want to share my highlights from the video, but of course I recommend that you watch the whole video. I will leave the link in the description. So let's check out my first highlight.
So I got the idea really by reading Peter Lynch's book, One Up on Wall Street, and it said that investing in stocks is an art, more than science. And, people that were trained to think very rigidly, to quantify everything, it's a big disadvantage when you invest in the stock market. So we're going to start with that. And
yeah, I have to say I do agree with Francois on that point. You see this a lot in the stock market where people are always trying to get exact measurements of things. For example, you can see people trying to estimate the intrinsic value of a company down to 2 decimal points. It's like Warren Buffett said, when you see a fat person, you don't know exactly how much they weigh. They could weigh 300 or 350 pounds. You don't know the exact weight. You just know the person's fat.
So if you want to be an artist in the investing world, well, you want to master that art. So you want to first choose an art that you really love. You want to study the masters of that art. And also it's important that as master paints, investor invests. So you want to be active in your art, and you want also to develop your own style, have an independent mind, and always strive for improvements.
Yeah, those are some great points from Francois. Said you want to study the masters. That's what we're doing now. We're checking out Franc ois Rochon. I'm studying Terry Smith, Warren Buffett, Charlie Munger, all the best investors. So we are studying. But it's also really important, like he says, as a painter paints, an investor invests. So we have to be actively investing. We have to go out there and do the thing and not just study it. It's similar to learning something like playing golf, for example. You actually have to go out to the golf course and play golf. It's not enough just to study YouTube videos and how-to guides online.
So perhaps we can go through our stock selection process. So that's the science part of it. So we start with this financial strength of the companies. We want companies that have higher return on capital, that have grown their earnings per share, that also at the same time have a strong balance sheet, so the debt to profit ratio. Usually we want something like less than 4 times.
Okay, if you look at the first criteria that he has on his stock selection, it is return on equity more than 15%. Personally, I emphasize the return on invested capital and return on capital employed. And I want to have that at the 20 plus range. He also talks about EPS growth. I favor free cash flow growth, since I do think it's easier for the management teams to manipulate the EPS. And finally, he has debt to profit ratio, which is less than 4, which is pretty similar to what I do. I try to buy companies that don't have any debt on their balance sheet, preferably. But if they do, I want to have as little debt as possible to run the business efficiently.
And we want a business model that is very solid. So we want companies that are market leaders, that have competitive advantage and low cyclicality. And the competitive advantage is very important, and I'll go back to that point.
So this is something that I've emphasized on the channel as well, to try to pick companies that have some kind of competitive advantages, have a deep moat, where they are market leaders in their industry, and preferably you want to pick a company that has low cyclicality, where they are just increasing the intrinsic value of the company year by year, and they're not relying on some force outside of the company, like a commodity price or something like that, to affect the earnings of the company.
So we want, the CEO, the CFO, the high management team to own lots of shares in the company. So you want a high level of ownership. So they're really in the same boat as we are. We want, managers that have good capital allocation skills. They make constructive acquisitions, and, they really think long-term when they make investments.
I agree with all of those points. That's exactly what I emphasize when I look at the management team. I want managers that have skin in the game, so they are in the same boat as investors. I want to see constructive acquisitions. Preferably, I don't want to see a lot of acquisitions unless they're a serial acquirer like Technion or Constellation Software or a company like that. And good capital allocation is something that you can see in the numbers. Is the return on invested capital or the return on capital employed always high if you compare it to what it was 5 years ago? Is it getting higher or lower? Is it always plus 20, plus 30? Those are the kinds of companies that we want to invest in.
Valuation. So we want a stock that will purchase at a level that, we can double our money over 5 years, which is sometimes 15% annual return. So, without being very precise, because we know that probably it's an illusion when you try to be too precise, we try to have a view of what we think the company can earn in 5 years. And it's going to help us to modelize what kind of valuation we can expect.
So Franc uses an evaluation technique, which I think is really good, where he's only trying to predict the earnings growth for the company for the next 5 years, instead of doing it for the next 10 years, which in my opinion is the problem with a DCF analysis, is that it's too long into the future. So ideally, we want to buy companies and hold them for 10 or 20 years. But the problem with that, it's really difficult to predict more than a couple of years ahead of time. So that's why I like his approach, where he's trying to buy the company at 50% of what he thinks the company will be valued in 5 years.
We bought that stock probably 11, 12 years ago. I think in 2005, we paid about $24. And it was the day that Bob Iger was an MCO. And we've done it since then. So there was a period when the stock did not do much. As you can see, for 4 years, the stock didn't do very well, but earnings kept growing, and we were patient. And if you look over the 12 years we've owned the stock, earnings have grown about 13% annually. And in the end, the stock has more than quadrupled. So if you're...
It's another good point from Francois, where he bought Disney back in 2005. And in 4 years, nothing happened with the stock. But the earnings kept on going up, so he was patient. And in the end, he got a decent return on Disney. I don't know if he's still holding Disney, since I don't think the company is as good as it was. But still a good lesson from him. I do have 1 or 2 companies in my personal portfolio that have gone nowhere for a couple of years, but the earnings have been going up. So maybe their time will come as well. We'll see.
And that comes up to something we put out a few years back. I call it the rule of 3. It's really to accept that 1 year out of 3, the stock market will decline by 10% or more. 1 stock purchase out of 3 will not perform as expected. And 1 year out of 3, you'll underperform the index.
Well, this is a really great rule from Francois. I learned this when I was reading his letters. That is something that you have to accept. And it took me a while to get the rule number 2. But 1 stock purchase out of 3. So if you have a portfolio of, let's say, like I do, I have 9 stocks. Probably 3 or 4 out of those will not perform as I expected originally, and might even do pretty bad. But I'll hopefully have those 6 stocks that will make up for the losses and then some. And if you are able to outperform the index 2 out of 3 years, you will do pretty good in the stock market, and you will outperform most investors.
But if you go back to the example of CarMax stock over the last decade has been quite volatile. It went down 25% a few times. But if you look at the earnings over those 10 years, it's been a pretty stable business. So if you just focus on what's happened to CarMax over the last 10 years, I think beside 2009, earnings went up every year, and it grew earnings by more than 16% annually. So just focus on that and forget about the stock price move.
That's why it's really important for us as investors to have something like look-through earnings, which is what I'm always showing you on Guru Focus, that you're focusing on what's important in the underlying business, and you're not focusing on what the stock price is actually doing. And that way it's much easier to be able to hold companies for a long time.
I would say the conventional investor, the typical investor in the stock market, either professional or amateur, It's really the focus on market quotes. They're short-term oriented. They have opinion on everything, and they try to predict when to buy stocks, and they cannot resist the latest fad. So I would say the unconventional investor, while he focuses on intrinsic value, he has a long-term horizon, he's agnostic about many, many things, including where the stock market will be in a few weeks or a few months. And at the same time, he doesn't try to predict when to buy, but he focuses more on what to buy. And I wouldn't say the right verb is what to own. And of course, he resists the fads and the popular.
So this is a really good list of, on the left side here, things that we don't want to be when we are investing in the stock market. But unfortunately, I do think the majority of people that actually are investing in the stock market are more on the left side than the right side. And if you look at the most popular finance YouTubers, you can see that what they're teaching on their channels is really most of the things that are on the left side, and especially the fact that they can't resist the latest fads. But I try to focus as much as I can on the things on the right side and try to teach that in my videos. That's probably not going to be the most popular approach when it comes to investing in the stock market, but it is still the best way to make money in the stock market in the long term. So that's it for my highlights from The Art of Investing by Franc ois Rochon. I do want to ask you to like the video and subscribe to the channel if you haven't already. I want to thank you for watching, and I will catch you on the next one.